I'd like to talk about this Excel spreadsheet that I developed. What it's used for is to determine how much of a stock that I should buy. And the way it works is you basically just fill out these 5 colored boxes, and once you're done, then not only will it tell you how many shares that I should buy, but it will also tell you where to place your stops. So let's just go through an example and I'll show you how it works. So the first question that you have to ask yourself is, what is your account equity? So how much money do you have in your trading account? So for this example, we'll just say $10,000. Now the next question is, how much of your account do you want to risk on each trade? So how much money do you want to lose if you're wrong? So as the quotes suggested, 1% or 2% is usually a good idea. So let's try 2%. So here, $200, that means if you're wrong, your account is going to go down in value by $200. The next question is, what is the price of the stock? So that's pretty straightforward. So let's just pick any stock, it doesn't matter which one. I talked on my blog recently about this stock, ticker symbol GV. The current price is $3.62. So let's enter that in there. With this Excel spreadsheet, you can use it for any stock. It doesn't matter if it's a penny stock or a blue chip. It can be used on really just any stock. The next question is the stock's ATR. So ATR stands for average true range. And what that is, it's just basically how volatile the stock is. How much does it move on average on a daily basis? Now to get that, it's a little bit more complicated. But what you can do is you can go to stockcharts.com, click on free charts. If you're not a member, type in the symbol of the stock. You get a chart of the stock. Scroll to the bottom to where it says indicators. Then you can add the indicator average true range. So then average true range is one of your indicators. Click update. Then average true range is added to the bottom of the chart. So we can see here that the average true range of this stock is 0.288. So what that means is, on average, the stock moves roughly 29 cents from high to low on a daily basis. So 0.288, type that in there. The next box is the ATR multiplier. So that is how many times the ATR below or above the price you want your stop to be. So the turtle is a 2 ATR stop, which is fine. I personally use 4 times the ATR. So that means that my stop would be $1.15 below the current market price. So now that we've filled out all 5 of those colored boxes, we get the information that we were looking for. So based on this example, I would be able to purchase 174 shares of this stock. The value of the trade would be $628. This would be my buy stop if I was short the stock, and this would be my stop loss if I was long the stock. Now what's interesting is you can change these variables, and if you change them, you get a different result. If the value of your account goes up, then obviously you can trade more shares, which is good because if the value of your account goes up, you can trade larger, and that can allow your account to grow exponentially. On the other hand, if the value of your account decreases, if you go into a drawdown, then you trade less, which is key because if you're in a drawdown, you want to trade smaller to keep your losses linear. Naturally, if you risk more, you can trade more. You can risk even 10% of your account, and you can trade a lot. Of course, most professional traders would not want to risk such a large percentage on each given trade, because imagine if you got 5 losers in a row, which could easily happen, then you'd be down almost 50%. The next thing is if the stock becomes more volatile, you trade less shares. If the stock becomes calmer, less volatile, you trade more shares. So I hope that makes sense. I found this very useful in my own trading. If you'd like a copy of this, I could email it to you. You could just visit my website, which is www.chartingtrends.com.